All right, welcome to the deep dive. Our mission here, as always, is pretty simple. We take these, huge stacks of complicated research,
Right. Articles, proprietary stuff, academic papers. It's a lot to get through.
and we just try to distill it all down into the essential knowledge you need. We'll find the surprising facts and hopefully keep it interesting.
And today we are digging into a really critical topic. I mean, this is squarely focused on long-term financial security.
It really is. It's a question for anyone looking at their retirement assets, thinking decades down the line.
The core question is this. How do you actually protect your capital? Not just from, the inflation you see at the grocery store,
Right.
but from these massive structural changes happening all over the world.
And the sources we've looked at for you, they lay out an extremely powerful, and I have to say, a very non-traditional investment thesis.
Very non-traditional.
This isn't about trying to time the market or picking stocks based on quarterly earnings.
Yep.
It's a much bigger idea.
It's about recognizing that the whole structure of the global economy has, well, fundamentally shifted. And the argument is that this new structure dictates only one really rational path to preserve your wealth.
And even grow it.
And grow it, absolutely. The analysis suggests that path involves a mandatory accumulation of one specific currency,
Just one.
and then a very concentrated investment in a really narrow group of companies. The thesis is just so clear, almost aggressive. It says the US dollar isn't just strong because of history or policy.
No.
Its dominance is now structurally mandated. It's baked into the global systems of energy and technology.
And that structure, the sources argue, ensures that all other currencies have to weaken against it.
Necessarily and continuously.
Okay, so let's unpack this. Our mission for this deep dive is to explore the two big foundations of this dollar power. There's sort of an old engine that's been kept running.
And a brand new one that's driving all the velocity.
Exactly. Then, and this is the crucial part for you, we're going to detail the specific two-part investment strategy that the sources claim will not just protect you from inflation.
But actually ensure you achieve significant wealth over the long term.
This is the blueprint, according to our material, for security in your later years.
Let's get into it.
All right, let's jump right into the central argument because really it defines the entire strategy that follows.
It's the absolute foundation.
Section 1 is just. It's brutal in its clarity. It lays out the core thesis for anyone thinking long-term. If you hold any currency other than the US dollar, the sources claim you are structurally destined to lose ground against it.
That is the starting point. I mean, the explicit advice in our material is stark. It basically tells you if you have other currencies, you must unconditionally accumulate dollars.
Unconditionally. It's not a suggestion.
No, it treats the dollar as a non-negotiable prerequisite. Step 1 for any kind of wealth preservation.
And we really have to stress, this is looking past simple market volatility, right? This isn't just about day-to-day fluctuations.
Oh, not at all.
The structural argument is what makes it so aggressive. Most financial advice talks about currency risk in terms of central bank policy.
Right, like the Fed is raising rates faster than the European Central Bank, so the dollar strengthens for a bit.
Exactly. But this source material is suggesting something much, much deeper is at play here.
Absolutely. The structural setup they describe means the global operating system itself is hardwired to extract value for the US dollar.
Hardwired.
Yeah. The premise is that the entire global economy is set up so that all currencies worldwide can only weaken against the dollar. This isn't about the euro having a bad quarter or a bad year.
It's about the euro having a structurally mandated handicap forever.
Forever relative to the dollar. That's the core of the argument.
And that is just a fundamental challenge to the idea of traditional diversification, isn't it?
It completely upends it.
I mean, you look at the history of reserve currencies. The Dutch guilder, the pound sterling, their decline was usually slow. It was driven by, big geopolitical shifts or economic mismanagement over time.
A natural cycle.
A natural cycle, exactly. But what the sources are suggesting here is that the US dollar is undergoing a structural lock-in, something that prevents that natural decay.
Precisely. And to really get how big a deal this is, we need to understand what structural weakness even means in this context.
Right.
It's the fact that the dollar isn't just what Americans use to buy things. It is the gravitational center, the necessary go-between for almost every single high-value global transaction.
Can you give an example of that?
Sure. Let's say a big German manufacturing company needs to buy industrial components from, say, South Korea, or a government like Brazil needs to pay back debt it owes to international lenders.
Oh, okay.
Those transactions are overwhelmingly priced and cleared in US dollars.
So even though the German company's bank account is full of euros, to make that purchase, they first have to sell their euros and buy dollars.
They have to. It creates this constant mandatory global demand for the USD. And that demand effectively pulls value out of the German economy and funnels it into the dollar system.
It's like a perpetual global tax or a subsidy for the U.S. currency.
Yes. The sources kind of imply an analogy. The dollar is the only ship on a tide that's always rising. If your money is in any other currency, you're basically tethered to the shore watching the water level go up.
And the sheer volume of these transactions must be astronomical.
It's immense. All these transactions that just bypass local currencies and settle in USD. It acts as a constant demand shock absorber for the American currency that no one else has.
And the moment you see it through that structural lens,
Mhm.
the connection to retirement security becomes, well, it's pretty chilling.
It is.
If you're a retiree living off your savings, your number one fear is your purchasing power disappearing over 20 or 30 years. They call it inflation. But if the local currency you're holding is, as you said, structurally programmed to lose ground against the world's most important assets, we're talking energy, technology, global commodities.
Then your local inflation is just one of your problems.
It's just one enemy.
Yeah.
The structural global shift is the other, more powerful and, ultimately the more insidious one.
And that's the crucial link this analysis makes. It reframes the whole problem. The primary defense against inflation isn't just about finding assets that beat your local price increases.
No.
It's about understanding this global shift. If your retirement nest egg is in a currency that is perpetually getting weaker on the world stage, you don't just worry about the price of bread going up.
It'll lose purchasing power on everything.
Everything that requires global access, imported goods, travel, and this is the critical part, access to the best global investment opportunities, which are, as we're about to see, dollar-denominated.
So for the person focused on retirement, this actually simplifies the decision-making process immensely.
It does.
If the dollar is the only currency with these guaranteed structural tailwinds, the key to protecting your long-term purchasing power is clear. You have to be in dollars, first and foremost.
It basically says that diversifying by currency is no longer a viable long-term defensive strategy.
Which is what so much traditional financial advice preaches.
Exactly. Hold some yen, some euros, some gold, geographic hedges. This model argues that those hedges are fundamentally futile.
Because they're all in the same sinking boat, just at different speeds.
They're all in the same structurally sinking boat relative to the USD. So according to this thesis, the only diversification that actually matters is the one you do inside the USD ecosystem itself.
I have to jump in here with a critical question because this thesis feels almost too perfect, too neat. What about the counter movements?
De-dollarization.
Exactly. We hear about it all the time. Powerful economic blocs like the BRICS nations trying to move away from the dollar. Do the sources even address that risk?
That's an excellent point, and it's one you should be asking. Yes, the sources address de-dollarization directly, but they argue that these efforts are, destined to fail.
Destined to fail. That's a strong statement.
It is. Or at least they're destined to fail to actually displace the dollar as the necessary reserve currency. And the reason, they say, is because of the mechanisms we're about to get into in Section 2.
So the political will isn't enough.
The political will is there, sure, but these de-dollarization attempts, they often focus on things like bilateral trade, swapping oil for yuan directly. But they fail to account for the two new massive structural pillars that are propping up the dollar now. They might chip away at the edges, but the core argument is they cannot overturn the entire global financial operating system.
So the structural lock-in is already too deep for these political movements to really counteract.
That is the claim. Geopolitical resistance is, at this point, insufficient to overcome economic necessity. And that necessity is what we need to dive into right now.
Okay, here's where it gets really, really interesting. This is where we connect that structural mandate to the specific mechanisms that make it work.
A how.
The how. The sources break down the dollar's power into two distinct, massive engines. two pillars that are working together to support this USD dominance. We have Pillar A, which is the new high-velocity engine.
And Pillar B, the old, sustained geopolitical engine that's still very much in play.
Let's start with the revolutionary part, the new engine, the rise of what the sources call the techno-dollar.
This is the crucial modern update to the whole thesis. For decades, the global financial system was defined by the petrodollar.
Oil.
Right, the agreement with OPEC.
Exactly.
Yeah.
Now, the sources are asserting the techno-dollar is taking over as the primary driver of currency demand, and it's driven almost exclusively by the dominance of the M7 companies.
The Magnificent Seven.
The Magnificent Seven.
And let's just establish the context here for our listener. When we say M7, these are not just valuable companies. We're talking about the massive US-based tech firms. The ones that dominate global cloud computing, AWS, Azure, Google Cloud. The ones building the generative AI infrastructure, running the global social and communication platforms.
And the mobile devices that we all use to access it.
Right. They are less like companies now and more like global infrastructure providers. Their services are essential for every single modern economy to function.
They've preempted the market, as the sources say.
That's the perfect phrase for it. They built the foundational railroads of the 21st century global economy. So now, any business, anywhere in the world, if they want to grow or be efficient or even just survive,
They have to pay the toll.
they have to pay the toll to access these platforms.
And the mechanism for how this actually fuels the dollar, that's the core of the techno-dollar thesis. The sources say that because of this market preemption by the M7, a vast amount of global settlement and transactions are ultimately being conducted in dollars. How does that flow actually work?
This is where that structural lock-in becomes so apparent. Let's trace the capital. Imagine a typical modern business, say a fast-growing e-commerce company in South Korea.
Right.
They're selling products locally. The revenue is coming in Korean won. But to operate, they require, let's say, 3 non-negotiable services, all provided by M7 companies.
What would those be?
1, cloud storage and computing power from AWS or Azure. 2, high-end, specialized AI computation time for their logistics and customer service bots. And 3, enterprise software licenses.
And they need these things not just to get an edge, but just to exist in the digital marketplace today.
Exactly. Now think about how those core services are priced. The M7 companies price their global service contracts, especially for high-value cloud and AI services, overwhelmingly in USD. So even if the local subsidiary in South Korea lets them pay the bill in won, that transaction is almost instantly referenced against a dollar-denominated global price sheet.
So if the Korean company has, say, a $5 million annual contract for cloud computing, even if they write a check in won, their bank or their own finance team is effectively going into the global market
And purchasing $5 million.
to satisfy that obligation.
And that conversion happens at a massive scale. Every second of every day, all over the world, that's the first engine of dollar demand from the system. But there are actually 2 more layers.
2 more.
2 more layers of financial necessity tied directly to the M7's power. The second one is capital repatriation.
Meaning bringing the profits home.
Exactly. When the Irish or the Singaporean subsidiary of one of these M7 firms receives that payment, those profits are eventually consolidated and sent back to the U.S. parent company.
Where shareholder dividends, R&D, all of that.
And these huge internal corporate settlements are overwhelmingly dollar denominated. So you have billions of dollars constantly flowing back to the U.S. from all over the globe, sucking up local currency supply and putting constant upward pressure on the dollar.
That makes perfect sense. The ultimate destination for the profit is the American headquarters, and the language of that headquarters is the dollar.
And the third layer is infrastructure financing.
Building the data centers.
Exactly.
Yeah.
Building and maintaining this global cloud infrastructure, the sprawling data centers, the specialized networking gear, the high-end chips from U.S. suppliers. It all requires massive, massive capital investment.
And that capital is raised in.
That debt, those bonds, the equity investments, they're overwhelmingly raised in USD and denominated in dollars. So the very act of growing the M7 infrastructure requires constant access to dollars and reinforces the dollar's strength.
Wow, that is a powerful self-reinforcing cycle.
It is.
The engine of modern commerce, digital services, data, AI, it literally runs on dollars. The sheer velocity and volume of these digital transactions must now dwarf so many traditional physical trades.
It does. It completely transforms what used to be a physical dependency, like needing barrels of oil, into a digital dependency, needing access to computation.
So this connects tech platform dominance directly to currency demand and stability.
Absolutely. The dollar is stable not just because it's backed by the U.S. government, but because every major high-growth modern company on the planet must access these M7 platforms.
And those payments require mandatory USD conversion.
Right. And the sources stress this is why these M7 companies are no longer just cyclical tech stocks. They are global, utility like infrastructure providers, and their success is completely inseparable from dollar dominance.
It sounds like an inescapable gravity well. If you want to innovate, you need M7 platforms. If you need M7 platforms, you need dollars. That's the new engine.
That's the techno dollar.
But even as we talk about this, revolutionary digital dependence, the old financial guard hasn't just gone away.
No, not at all.
And that brings us to pillar B, the sustained engine, the geopolitical persistence of the petrodollar system. This provides the structural floor, the stability underneath all the high-velocity growth we just described.
And the sources are really clear on this. The old system isn't dead. It's actually being strategically maintained and even modernized.
So while the petrodollar traditionally relied on, say, an agreement with OPEC,
Right.
the current system relies much more on U.S. energy dominance and its own geopolitical leverage. The sources cite two specific energy sources that are sustaining this: U.S. shale gas and Venezuelan oil.
Let's start with U.S. shale because that just radically changed the game for the U.S. trade balance over the last decade.
Oh, completely. The U.S. went from being a massive energy importer to a significant exporter, especially of liquid natural gas, LNG.
And that fundamentally alters the relationship between the dollar and global energy. Historically, the U.S. had to pay out huge amounts of dollars to foreign oil producers.
Yeah.
That money recirculated, but it was still an outflow.
Right. Now the U.S. is receiving massive inflows of other people's currencies, which are then converted to dollars from nations that are desperate for energy security.
This is key, especially after the conflict in Ukraine completely shifted Europe and Asia away from Russian natural gas.
So now, if Germany or Japan or South Korea needs energy security, which is a foundational need for their industrial survival, they are effectively forced right back into the USD market to buy American LNG.
It's energy self-sufficiency that's been weaponized into currency dominance. The fact that the U.S. can provide a reliable supply, priced in dollars, ensures that even the energy system remains anchored to the USD.
That creates a powerful, sustained physical flow of demand for the dollar.
It provides the stability floor. That's what the sources argue.
So what about the other part, the geopolitical component? The inclusion of Venezuelan oil in this analysis feels less about supply and more about control.
That's exactly right. Venezuelan oil is cited not for its current export volume, which is often restricted by sanctions,
Of course.
but because of the specific sanctions architecture that surrounds it. The U.S. leverages its financial system to dictate who can buy Venezuelan oil under what terms, and crucially, through what financial clearing mechanisms.
So it's the sanctions architecture itself. So for a foreign company, a trading house, a non-U.S. refiner, even if they manage to navigate all the complex diplomatic hurdles to get access to that supply.
They still have to contend with the U.S. financial system's ability to freeze their assets or track their transactions.
And they don't want to get on the wrong side of that.
Nobody does. So the sources emphasize that any nation wanting to access that supply, or even just wanting to ensure they are compliant and avoid U.S. financial penalties, they have to engage through dollar-denominated channels and frameworks that the U.S. government ultimately controls.
It's a mechanism of financial control, not just trade.
Precisely.
So the U.S. uses its power over financial flows to make sure that even non-U.S. energy sources remain tethered to the dollar system. It's essentially a toll booth on global energy trade, even for oil the U.S. didn't produce itself.
And that combination is the lock-in. U.S. shale provides the physical export dominance, ensuring there's a supply-side demand for dollars.
And Venezuelan oil and the sanctions architecture provide the geopolitical control, ensuring there's a compliant side demand for dollars.
And this dual support ensures the dollar maintains its supremacy in the crucial global energy trade. It provides a deep, robust floor of stability beneath the tech-driven growth of the techno-dollar.
When you put those two pillars together, I mean, the sheer weight and stability of the petrodollar floor and then the incredible velocity of the technodollar transactions on top, it really does create a closed loop of global necessity.
It does. You need dollars for energy to keep the lights on, and you need dollars for innovation to stay competitive.
There's really no escaping the structural need for the USD.
And that necessity is why the sources are so dismissive of the de-dollarization efforts. Even if China and Russia agree to trade oil in Iran, the moment that Russian company needs advanced semiconductors from a U.S. supplier.
Or the moment they need to store their financial data on a robust cloud platform.
They are immediately brought right back into the dollar ecosystem. The necessity of the technodollar undermines any political attempt to escape the petrodollar.
That structural reality has to be top of mind for anyone planning for decades of financial security. You're not just betting against a currency. You're betting against an economic force that has these two reinforcing, globally essential pillars.
A huge undertaking.
The dollar isn't just winning in traditional trade and new tech, though. It's also, aggressively occupying the decentralized space, the very space that was originally meant to be its antithesis.
And this brings us to Section 3, the digital reinforcement.
Right.
This is a really fascinating layer of complexity and, well, stability that gets added to the argument. We're talking specifically about the rise and the widespread adoption of dollar stablecoins.
And the sources make a very specific claim here. They say these dollar-pegged coins are occupying Bitcoin's place.
They are.
I remember when Bitcoin was supposed to be the ultimate hedge, right? The escape from central bank fiat currencies, the digital gold that would eventually unseat the dollar.
That was the dream for a lot of people.
Yet what we see in practice, in reality, is that the vast majority of transactional volume and liquidity in the entire crypto world flows through tokens that are explicitly pegged one-to-one to the US dollar.
USDC, USDT, BUSD, the list goes on. They aren't an escape from the dollar at all. They're the dollar's most efficient digital manifestation.
They're basically just digital IOUs for dollars.
Essentially. They're digital liabilities that are either redeemable for real dollars or, more commonly, backed by dollar-denominated assets, usually short-term U.S. Treasury bonds.
And their appeal isn't revolutionary, it's practical.
It's completely practical. Stability, speed, and the ability to move them across borders easily. If you're a global crypto trader or a business in a country with a really volatile local currency, you don't want the 10% daily price swing of Bitcoin for your transactions.
No, you want something fast, stable, and instantly priceable in the world's most trusted currency. You default to a dollar stablecoin.
You do. And the implication of this for the dollar's structural stability is profound. This widespread adoption means that even in the most cutting-edge, decentralized, high-tech financial markets,
The ones supposedly designed to undermine the whole system.
even there, the USD remains the default reserve currency and the preferred medium of exchange. So the growth of crypto, far from being a threat to the dollar, is actually an accelerator for it.
That is a wild idea. Can you break down the mechanism there? How does me using a stablecoin actually increase demand for real underlying dollar assets?
It creates huge institutional demand for safe USD-denominated assets. When a major stablecoin issuer like Circle or Tether mints, say, 10 billion new tokens,
Right.
they have to hold an equivalent value or something very close to it in liquid dollar assets to back those tokens. And those reserves, they often consist of short-term U.S. government debt, high-quality commercial paper, or just cash and bank deposits.
So the popularity of the stablecoin is directly driving demand for U.S. Treasury bonds.
Exactly. Every time a new person or a new company enters the crypto world and buys a stablecoin, they are essentially creating billions of dollars of demand, not just for that digital token, but for the underlying dollar assets held in reserve by the issuers.
Wow.
It ties the explosive growth of the decentralized financial world directly to the fundamental stability of the U.S. sovereign debt market.
So for the long-term retirement investor, this is just another layer of stability being added to the overall argument.
It is.
Even if some major technological disruption comes along and sweeps away traditional banks, the dollar's central role remains because the new systems are being built on top of it. The dollar has captured the innovation cycle.
It ensures that the USD remains the foundational reference point for creating and transferring wealth globally. It doesn't matter if the money moves through the old SWIFT system, through an M7 platform, or across a decentralized blockchain.
The dollar is the necessary common denominator.
The sources present this as an invincible technological moat that's protecting the currency.
So, okay. We've established the argument for this structural inevitability. We have the petrodollar floor providing stability, the techno-dollar engine providing velocity, and this digital stablecoin capture acting as a massive distribution network.
It all points in one direction.
The dollar must win, and all other currencies must, structurally, weaken relative to it.
That's the thesis.
So, given this monumental structural advantage, what does this all mean for you, the listener, focused on your long-term assets?
Yeah.
You're looking for that specific roadmap to financial security, to a comfortable retirement.
And the sources provide a very specific, very actionable two-part investment recommendation based on all this
This
analysis.
is where the theory becomes practice.
Exactly. This is where it translates into action for the conservative, long-term investor. If you accept the premise that all non-dollar currencies are destined to weaken, then the primary defense is strategy part one, a mandatory USD position.
Which, as we've said, means you need to accumulate and hold assets that are denominated in US dollars. But let's really dig into the why of that for a second. It isn't just about trying to earn a better yield.
No, it's more fundamental than that.
It's about having a fundamental hedge against that slow, inevitable erosion of value in non-dollar currencies over a 20 or 30-year retirement horizon.
The sources insist that merely holding USD-denominated cash or very low-risk assets, say short-term U.S. Treasury bills, already puts you far ahead of someone holding long-term assets in a weakening foreign currency.
So that's step one, capital preservation 101 in this new framework.
Right. You secure your base purchasing power against the global structural trend.
But preservation isn't enough,
Yeah.
right? Especially if you're planning for decades in retirement. You need growth to beat inflation and actually increase your real wealth.
And that brings us to strategy part two, which is the highly specific investment recommendation, investing in M7 ETFs.
The vehicle here is very targeted.
Extremely. ETFs that track the M7 companies, the sources call them dollar-based platform commanding enterprises.
I like that phrase.
It's a good one. You're basically making a concentrated, high-conviction bet on the handful of companies whose success is directly tied to the structural dominance of the dollar itself.
The very engine driving the techno-dollar thesis.
The very engine.
Now, this goes against so much common advice. The mantra of broad diversification across sectors, across geographies. The sources are essentially telling a retiree to ignore that advice and concentrate in the core engine of global commerce. Why is that high concentration risk justified in their view?
It's because it's a double play that, in their view, fundamentally redefines what risk even is.
How so?
By investing in these M7 companies, you benefit from two incredibly powerful forces at the same time. First, you get the monopolistic growth and the incredible profitability of the platforms themselves. They're extracting rents from nearly every economy on Earth.
Okay, that's the company growth.
And second, you get the compounding benefit of the dollar appreciation that their own dominance helps to fuel. Your investment is literally tied to the currency's structural success.
And the sources make a truly staggering claim here. They say investing in the dollar in these specific companies is the key to both beating all inflation and achieving significant wealth. The quote is, becoming rich.
It is.
That level of confidence demands a really robust defense of why these assets are uniquely protected.
And we need to address the obvious counterpoints, the questions you should be thinking about right now. What about antitrust risk? What about market saturation? What if a geopolitical rival tries to build its own cloud platform?
Exactly. Why are these companies supposedly beyond typical cyclical risks or even regulatory risks from governments?
The argument is twofold. On the regulation point, the M7 firms are now so deeply embedded in the operations of the global economy.
Right.
I mean, hospitals rely on their cloud data, entire nations rely on their communication platforms. Dismantling them would cause catastrophic global disruption.
So regulators might talk a big game.
But they can't seriously impair the function of a global utility without causing immense self-harm. They are, as the old saying goes, too big to fail, but in this case, it's more like they're too essential to regulate effectively.
Okay, what about competition? Market saturation.
The sources argue the network effects are just overwhelming. For example, the cost for a large company to switch its cloud services from one provider to another is astronomical and operationally very dangerous.
It's a huge risk.
The huge risk. And furthermore, the massive capital required to even try to build a competing AI or cloud platform, the data centers, getting the specialized chips, it's all priced in dollars. So the barriers to entry are themselves dollar denominated, which just cements the M7's advantage.
So the investment advice is to tie your retirement portfolio's fate to the most structurally essential dollar-fueled components of the entire global economy.
Yes.
The thesis suggests that these concentrated investments protect your portfolio's value over decades, far better than a geographically diverse multi-currency strategy.
Which, according to this analysis, just introduces unnecessary structural headwinds because you're dabbling in currencies that are designed to weaken.
It does simplify the complexity for the investor. Instead of having to worry about economic slowdowns in dozens of countries.
You focus on the handful of companies that control the flow of data, commerce, and money across all of those borders. If the dollar is structurally invincible because of the petro and techno pillars, then these companies are the economic shock troops that make it so.
And are therefore presented as the ideal long-term asset for stable growth.
That's the idea.
Let's talk about that specific promise, beating all inflation. Are the sources suggesting that the growth of these M7 firms will inherently outpace not just U.S. inflation, but global inflation measured in all these different currencies?
Yes, because their pricing power is global and it's absolute.
What do you mean by absolute?
When a cloud platform raises the price of its compute time, every business globally that relies on that service has to pay up. It doesn't matter if they're in Tokyo or Toronto, they pay.
And that price increase automatically translates into higher revenue denominated in dollars for the M7 company.
Immediately. Meanwhile, the local currencies in Tokyo and Toronto are the ones that have to absorb that cost. So the M7 are perfectly positioned to pass on any inflationary costs with immediate effect, which makes them a fantastic structural hedge.
It's a compelling, I'll admit, albeit highly concentrated, strategy. And it's aimed squarely at alleviating that constant anxiety that retirement savers have about losing their purchasing power.
It is.
They're being told to stop playing defense with diversification and start playing offense by owning the very engines of global currency demand.
It's a thesis that requires a profound trust in the permanence of this techno-dollar structure. But if that structure holds...
The source claims the returns are essentially mandated by global necessity.
Exactly.
So to synthesize all the immense detail we've just explored.
The overarching thesis is, I think, crystal clear by now. The dollar's structural strength isn't just about the old geopolitical pillar anymore. It is now dual-powered. You have the sustained geopolitical energy framework, the petrodollar providing that stable floor, and then you have the dominant technological platforms, the technodollar providing massive, accelerating velocity.
And it's all reinforced digitally by stablecoins.
Which act as a distribution network.
And this combination, the sources insist, renders all non-dollar assets fundamentally weak. They are structurally disadvantaged for long-term wealth preservation.
Therefore, it mandates a specific, assertive, but what they would call a low-risk investment path for both capital preservation and growth.
Secure your base in dollars and then go long on the handful of companies that have made the dollar indispensable to the modern world.
It's a very comprehensive roadmap, and it's designed specifically for you if you're an investor who's worried about inflation and financial erosion over the course of a multi-decade retirement.
It demands a total reevaluation of traditional diversification advice.
It does. It centers the entire portfolio around the structural necessity of the USD and its most powerful operating components.
It's a concise, assertive, almost military-style strategy. And it definitely forces you to reconsider traditional portfolio design, especially if you've relied heavily on geographic currency hedges in the past.
Indeed. I mean, if you look at this through the lens of a conservative investor who just wants peace of mind, owning the companies that control the global flow of money and data, it offers a type of security that local bonds or geographically diverse stocks in this framework simply cannot match.
And that leads us to our final provocative thought, something for you to consider, to mull over on your own, that builds on this powerful analysis. Okay. If the argument holds, if the U.S. dollar's dominance via this techno-dollar and petrodollar structure is truly as inevitable as the sources claim, does the very concept of traditional geographic or currency diversification for retirement assets become obsolete? Or does the savvy investor need to evolve and seek out a completely new type of hedge, maybe an asset entirely outside the digital and energy structures, against what would otherwise be an invincible currency?
A big question to ponder. Thank you for joining us for this deep dive into the future of retirement finance.
We'll catch you next time.